with you this morning. The question, I think we didn't know how to start this issue of impact bootcamp, and after spending some time this morning here in this venue, I think I'm a bit more cautious about touching this issue of impact because it got such a huge glamour around that, and we're going to drill down to what impact really means, especially environmental and social impact of startups and for companies. So what we got planned for you? We're going to start with kind of a general introduction from my side about global challenges, presenting the UN Sustainable Development Goals, a little bit of history. We're going to talk about the business case of the UN SDGs. There's a lot of money going around the SDGs. We're going to present just one case study or what we called SDG scorecard. Then we're going to go on with Gila about measuring impact and initial approach, question and answers. And in the end of that, if you survive our amazing presentations, you're going to be rewarded by a pin. You see this? This is the SDG pin. Ah, Vanessa. You're going to be rewarded, and you're going to go around in this venue, going around with this pin, and you're not a member of a secret elite of the Shabak, but it's you're devoted for the SDGs. So my name is Liad Ortar. I'm the head of the CSR institution. The CSR institution is an academic, proactive institution, part of a college in Ramat Gan. I'm also a doctoral student at the University of Haifa, the Department of Gerontology. Who knows what gerontology is? Yeah, what is it? Yeah.
Study of the elderly?
Of the aging, yeah. Aging is a societal general issue, so quite a multidisciplinary kind of guy. And we're going to just start our journey now.
Welcome, everyone. We're here to discuss a crucial and urgent agenda that will have profound implications on our company, but also far beyond the four walls of this boardroom. It's time to talk about the Sustainable Development Goals, or SDGs, and what they mean for business. The SDGs were agreed upon by world leaders in 2015. These 17 goals are a universal framework aiming to tackle our most pressing social, economic and environmental challenges on the road to 2030. These are big goals, and they aren't just goals for the developing world. Every country has work to do. They'll transform the world we live in, for the better. But what role is there for us as a business? Isn't this just something for governments to deal with? Quite the opposite. The truth is that these goals can't be achieved without business. Businesses like ours are the driving force, an essential part of the process. But it goes further than that. As much as the SDGs need business, long-term business success hinges on the goals being realised. Let's look at the SDGs from four key angles. Environmental and social challenges are limiting growth and costing us greatly. The SDGs can reverse these trends. Let's act early and manage our long-term risk, stay ahead of policy developments and protect our competitive position. Doing nothing will be a costly option. Business solutions that align with the goals stand to open up at least $12 trillion per year by 2030. We'll also create new jobs and better support the communities we operate in, helping us build trust with our governments, shareholders and customers. Better information equals better decision-making. Disclosing sustainability risks and impacts and pricing them appropriately is where the market is headed. Finally, achieving the SDGs is beyond the reach of any one company. We must work together. So integrating the SDGs into everything we do will help our organisation become more competitive, more resilient, and ultimately more successful. Together, we can turn these goals into business action, resulting in a more prosperous world for everyone. It's time to take action. Let's be part of the solution.
So it was a very short picture by the World Business Council on Sustainable Development about the SDGs, but the issue of impact didn't start yesterday, okay? It didn't start even in 2015 when the SDGs were approved. If we have to go a little bit back into the future. back into the past in order to get some perspective of what is the overall context of when you talk about impact measurement. And I want to give just three, let's say, milestones in the development of this approach, or this global approach to resolving social and environmental issues. So first of all is 1972. It was the first global convention that dealt with environmental challenges. Okay, 1972 didn't deal with climate change and issues like that. It was pure, very dramatic effect of environmental malbehavement, such as mercury, such as persistent organic pollutant (POPs) that were used in DDT and as pesticides in agriculture. It was post the 60 flower revolution, whatever you want to call that, and it was the first time that representatives of more than 100 governments from all over the world gathered in Stockholm, Sweden, and decided they had a resolution, I think 23 articles or something like that, and decided about the right for humans to live in a safe environment. This was the first milestone and a crucial one, the issue of eco-development. The second milestone is the Brundtland Report 1987. The issue of Brundtland's report was how we create a kind of a compromise between the ever-growing demand and need and requirement to expedite growth, financial growth, GDP, and all those other indicators, with the fact that it's causing harmful effects on the environment and the natural resources. And they came up with this term of sustainable development. It was a political compromise. But since then, the issue and the term sustainability has been used like everywhere in a lot of contexts. The fact that it was so broadly used caused that to be a little, the sting was drawn out of this concept. And there was an understanding that we need to start creating functional ideas about what sustainability is. And the next one, the next stage was, okay, let's try and articulate what are the social and environmental goals we want to reach. And they came up, the UN came up with the MDGs, the Millennium Development Goals. The nature of the MDGs basically represented an approach that divided the world into developing countries and developed countries. In those years, Israel was still a developing country. Now we are developed countries. But there was kind of a decree that developed countries have responsibility over developing countries, and the goals. I didn't do anything. And those Millennium Development Goals were designed to create an inflow of money, of resources from developed countries into developing countries. And you can see that very nicely, whoever follows the issues of global climate change issues, about the Kyoto Protocol, creating this kind of market and allowances system that you pay for your pollution by encouraging the technological development in developing countries. And the goal was to, every 15 years, to write a new set or to create some kind of exam. Did we succeed in reaching those goals? There's some controversy over the issue. Did we really got to those goals? And you can see the way that they are written. These are problems that are basically dealt with in developed countries, in developing countries, and not in developed countries. Still yet, these MDGs were very, very general, okay? They were very, very general, not very specific. You could take them to wherever you wanted to take them. So here we came to the resolution that was accepted in the UN Assembly in September 2015, what we call Sustainable Development Goals, or the SDGs. So we evolved from the MDGs to the SDGs. And the structure here is a much more broader structure, okay? We have 17 goals that basically cover each and every societal and environmental issues you can think of. It's like a supermarket. Everyone can find its own products, whatever he likes to prepare his lunch from. So you have the 17 goals. you have the 169 targets, and in those 169 targets, you have 232 indicators. So it's a huge methodology and basically covers each and every societal and environmental angle that you can think about. But most importantly, it created a language, okay? You cannot talk today about impact investment or any other terminology you want to use, whether it will be responsible investment, corporate social responsibility, CSR, triple bottom line, whatever you want to call that. You cannot do that without relating to the SDGs, okay? This is a terminology that everyone in the world talk about and create this common language, create a way to communicate to your potential partners and investors and customers. And it's crucial that you will be able to map yourself inside this huge methodology. I'm going to show you just a couple of examples how this methodology is being used. And it is very important for me to emphasize that the SDGs is a state authorized policy. So SDGs were accepted by states at the UN Assembly. They were not designated in order to become what we call a managerial approach for businesses, okay? They were designated in order for states, for countries to prepare their public policies, whatever they're going to be about. But we do see how corporations are doing that. But the first one is a very nice project called GapFrame. It's from the business school from Lausanne that are basically analyzing all the countries around the world according to the level of say adherence or the level of completeness of working according to the SDGs. And this one is about Israel. We're not going to go into detail. Just visit the website, GapFrame, find your country, see what are your weak zones and what are your strong zones. It's a very, very interesting methodology. Of course, there are other methodologies other than the GapFrame. There's the SDG Index of Jeffrey Sachs. There are more. But also companies are doing work with the SDGs. And I'm going to give 2 examples from sustainability reports, one of the things that I'm doing in my everyday work in the institution. And this is how, I'll start the sentence again. Each and every sustainability report or a non-financial report or a CSR report, call that however you want to do that, start with a prioritization analysis. It's called materiality metrics, okay? What's most material issues for the company? And materiality metrics is kind of this diagram, this kind of graph, and this is how the sustainability report of Bank Poalim starts with, and you can see what are the most important sustainable goals is the upper right side and the least important on the lower left side. And this is how the report starts with. The other example is from another bank, Mizrahi Tfachot, and I gave example from also from the report. From the last part of the report ends with what we call a GRI index or index of content. And this graph also shows how the different SDGs are being addressed in the report itself and what pages you can find the actual addressing of the company to those specified SDGs. This is an example of an Israeli startup called Ecos, and you can see how they work with companies in gathering data from different locations around the world, and the data is the way it is being collected from the different sites. Already you allocate it according to the SDGs. Okay, and there are a lot of companies today that know how to integrate the SDGs into data collection software, and at the end be able to prepare report for investors, for customers, and of course for the rest of the stakeholders. As I promised you at the beginning, we talked about the business case of the SDGs. Okay. So there is kind of the moral aspect and the financial aspect, okay? The financial aspect is very clearly defined by different reviews, different reports. You can find them, there's quite a lot of them. Maybe Gila would in a presentation talk about that. But we're talking that if we'll take only the financial resources that are available by countries, by state, they are simply not enough if you want to reach the SDGs. Okay, they're simply not enough. There is a place for the financial intervention of the private sector in reaching the SDGs. How much? Trillions of dollars. There's one that say 5 to 7 trillions per year, and they say $12 trillion of market opportunities. There are huge financial opportunities once you connect yourself and your impact to the SDGs. Okay? This I wanted to skip. I would like now to present a case study and show you the fact of how it's being done. Okay? This startup that I'm part of their advisory board and their environmental consultant called Radgreen, their CEO Sigalit sits here. She takes a picture of me. Hi, hello. Okay, and I'm just going to show you the flow. Okay, and the flow is extremely important because impact, especially we're talking about environmental and social issues. I'm talking social. We can talk about the issue of aging. It's a very hot topic today, but also environmental topics. It's a very concrete procedure about measuring impact. It's not empty words on a screen. There's a practical way to do that, and that's how we can do that in a startup that develops and manufactures low-cost air pollution sensors. So first of all, you can see here that we have the SDGs that we are relating to, and that's number 3, good health and well-being. And then you have the target, 3.9. By 2030, substantially reduce the number of deaths and illnesses from hazardous chemicals in air, water, and soil pollution and contamination. Okay, so we have the goal, we have the targets, and then also we have the indicator. 3.9.1, you can see that they are all relating. Mortality rate attributes to household and ambient air pollution. So this specific addressing of this issue by this very big corpus of the SDGs. How they are doing that? They have low-cost, reliable air pollution sensors, their deployment in dense network, real-time measurements and alert, and reduce exposure to ambient air pollution. We're not going to talk about here about air pollution. You want to talk some more, you can address me later on. But at the end of this process, you have what we call impact performance indicators, the IPI. How do you measure impact? And for example, the way that Radgreen can measure their impact is the number of people receiving information, the number or size of authorities engaged, normative effects like regulation, enforcement, and things like that, public awareness. These are all measurable impacts, okay? There's a way to measure all of that. And that's how a SDG scorecard can look like. Of course, you can develop one according to your needs, but that's how we make the connections between the general theme of SDGs and specific impact performance indicators. Any questions? Yeah.
How can you measure public awareness on the part that you don't know that it's 100% on your behalf? It could be other companies who are doing the same thing who also creates impact.
It's a way of how you construct a research. We can talk about that. It's how you construct a research and measure things, okay? And then you have to isolate your contribution to the overall. But there's the ways to do that, okay? It can be done. I think you okay? I didn't lose you in the way. Gila, now it's your turn. We'll have more room for question and answers at the end of that. And don't forget to wait to get your pin at the end. They are all here.
Hi, everybody. Thank you so much for coming to our workshop. And I hope that you've been very inspired by all of the incredible companies you've seen, especially out in the plenary. I know that I was brought to tears, so I hope it's not smudged all over my face. But what I want to try to do for you today is kind of unpack the process that goes into thinking about impact measurement. And you saw, of course, companies that are doing very, very sophisticated things. The impact that they're generating is multidimensional. It's economic, it's social, it's environmental. And I think that by introducing some very, very basic key approaches to impact measurement, you can kind of wrap your head around the basics and then kind of develop your approach and then apply it to more sophisticated test cases. So I'll jump right in. So just a few words about the organization that I work at. I'm from Social Finance Israel. Some of my colleagues are here in the audience, and I definitely invite you to speak with them about the work that they're doing. Several of them are from the social impact bonds team. I'm from the advisory team, and we really kind of cover two very different approaches to impact and performance management. So I definitely encourage you to reach out and hear more about the applications of our different approaches. But in general, Social Finance Israel was founded in 2013, and we work to deliver measurable social and environmental change by deploying innovative finance tools that tackle social challenges. We are a founding member of the Social Finance Global Network with sister organizations in the UK, US, and just this year, India and the Netherlands. And we also coordinate the National Advisory Board for Impact Investing here in Israel, which works to catalyze the impact investment ecosystem here, to move it forward, to bring in new market players, to advance policy and regulatory change that will be favorable to this approach. And we also, and the NAB is represented globally. Israel is a member country of the Global Steering Group for Impact Investing, which is coordinating globally with about 23 countries globally on how to really push this market forward. And so what I'm speaking about really is kind of the tools and approaches that are used in the field of impact investing. Impact investing, just to provide a definition so that we're all on the same page, is about investing into companies, organizations, and funds with the intention to generate a measurable social and environmental impact alongside a financial return. And I think I just wanted to illustrate kind of what is the difference between impact investing and traditional investing. Well, the difference is sort of the light purple and the gray area all the way over to the right-hand side. So you'll see kind of in the small brackets, you have investors, you have potential intermediaries that are being go-betweens between them and the investee and the portfolio company. But I think and what I want to kind of get across to you is that impact investing takes on two additional dimensions. It is about looking and focusing on a social or environmental challenge and bringing about measurable solutions. So, I mean, of course, the companies that you saw out on stage today, there's no doubt about it. I mean, even emotionally, you know that they're changing the world in very, very profound ways. But what kind of differentiates normal investing from impact investing is this quantifiable, measurable change. Why measure? First of all, on your seats, you have a copy of this ecosystem report that we put out with OurCrowd and with the IVC Research Center and the Israel Innovation Authority. And basically, if you open up to one of the pages, you'll see a very, very interesting statistic from a survey that we put out. It's an indicative survey. It's by no means representative of the whole Israeli impact-related ecosystem. But basically what it says is that when asked, startups that align to the UN Sustainable Development Goals, which Liad explained earlier, 84% of them say that they're generating an impact. However, if you look deeper at their practices, only about 13% of them are measuring their impact. And so we want, and as part of the impact investment ecosystem, to encourage more companies to put data behind the impact that they're generating. And I'll explain why that data is so important. So as you can see here on this slide, I kind of summarized 4 key reasons: compliance, consumer priorities, for investor analysis, and for the company, for them to actually just be able to convey the actual impact that they are generating. So quickly, just compliance. There are countries out there that are actually regulating and mandating companies above a certain threshold, I think with like 500 employees in the UK, for example, to report on the social and environmental impact that they're generating. They also want to know about operational information, not just information about what the business model is generating, but actually how the company takes care of its employees, how it deals with waste and disposal of materials, how it manages its supply chain. And so it is a mandatory activity in a lot of jurisdictions. Also, with regard to fiduciary duty, there are certain fiduciary regulations and practices. So, for example, if there's a pension fund or an asset management firm that's managing somebody else's money, they have to comply with fiduciary duty. They need to be loyal to the person or to the shareholder whose money that they're managing, and they also have to invest with prudence. And so this kind of takes us closer to the idea of impact and to the challenges that Liad explained here, where if you're not taking account of these challenges into your business and into your investment approach, it stands to materially affect the business, and then it will also affect the returns that are being generated by the company. And so this is something that our domain is trying to get across to pension funds and to asset managers, that these types of issues are very, very critical. I'll just move on. So also, I mean, I just moved from the UK about a year ago, and I'm from the US, and I know that in those places, consumers are really making their voices heard. They want to know what kind of impact the products that they're buying are generating. And so this is driving companies to kind of position themselves better, to communicate better about their business practices, and then it translates at the end of the day into bottom line, into your ability to sell your products and to really scale in your own market. And it also helps you. And since it's such a beginning, an early stage of the field, you really can have competitive advantage, I think, as well, if you are transparent and forthcoming about the impact that you're generating. From the perspective of investors, and there's going to be a panel where you'll get to really hear about the practices of impact investors. But really for them, I think that impact management and impact measurement is an analytical tool. Here they are, I mean, even just from the plenary session, how do you decide? How do you know what to invest in? How do you know what impact is going to be generated? It's day one that you're going to make your investment, but of course you're going to want to support that company for 5, 7 years out, 10 years out. What kind of impact is going to be generated after that time? And so you want to draw that information back in and be able to use this type of data from companies to understand and compare apples to apples, in a sense. And that's where data-driven impact management is so important. And then finally, I think, and this is really most important, and this is where I believe it's most important for impact management and measurement to originate from, it's actually the companies themselves. It doesn't come from the investors, and the investors say, here, you must measure X, Y, and Z. But rather, it's about the company's ability to know exactly what it's doing, to be able to manage itself properly, and know what kind of impact it's generating. And then, of course, if you are a company that does want to attract impact capital, and also from our survey, I don't know if it actually made it into the report, but we did find significant findings that impact-related companies are interested in raising capital from impact investors. Impact management and measurement is a key way of connecting with that kind of cross-section of investors who are looking to know what impact is being generated. Just to give you a sense of how broad this practice actually is, there's currently $228 billion under management in this approach, which is, I think, enormous, considering kind of how new impact measurement here is in Israel. I think, these are numbers from last year, so I think that the field has even grown. just to give you the name of a very interesting tool that that I like to look at from time to time, it's the Impact Investing Network Map. And here you can really, all these tiny, 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 tiny dots, these are investors and companies that are actually measuring their impact. So it's quite broad. It's quite broad as a practice. And then here with the gray circles, you can see how fast and how kind of consecutively and thoroughly this field of impact measurement and investing has grown over the years. So in the last 3 years, there's this cumulated annual growth rate of 35%, which is pretty astounding. So how? What do I do? How do I approach this issue? What do I do? This is sort of my rote approach. It's very basic, I'll admit. But it's essentially set goals and targets, define your strategies, select metrics, and set some targets for yourself as a business. And then, of course, measure, track, use the data, and like your favorite weatherman, report. So first, let's unpack this a little bit more. So set goals and targets. There's a very useful resource called the Impact Management Project that lays out some key guidelines on how to go about unpacking and surfacing the impact across a variety of different important dimensions for impact. So, you're looking at it asks companies and investors, but let's focus from the point of view of companies. What outcomes are being addressed by this business, and how important are they to the people who are experiencing these outcomes? How significant is the effect in terms of the time period? Who are your customers? Who are the beneficiaries of whatever type of service or product you have on offer? And then contribution. How does the effect compare and contribute to what's likely to occur anyway? So in the beginning, I talked about kind of the key parameters of impact investing, which were intentionality and measurement. And I think additionality also is a key component. So you want to know, would this response, would this product or service benefit this population if not for this investment or if not for this company? So you really want to, as a company, be able to right, and then risk. What's the risk that this impact is not going to happen? So I encourage you on your own time to look into the Impact Management Project, which explains all of these dimensions in a lot more detail and really is a key resource for investors and for companies to use as they think through this process of impact measurement. Once you have defined your goals, you want to think through your strategy. And what's typically used in the domain of impact investing is what's called the theory of change. And it's really a tool that enables you to visualize the day-to-day activities that you're doing that will help you reach your stated mission, that will help you reach your goal. And so it's broken down into assumptions, inputs, activities, results, and outcomes. And it's really, this is a map that will help you really understand how you're seeking to make that impact. What partners are you partnering with? What countries are you selling to? What are some of the strategic decisions that are going to help you ensure that impact is generated through your business? And then more on the practical side, IRIS, which is a catalog of metrics, is a resource that you can use that's put out by the Global Impact Investment Network. And it's a very, very useful tool because it's exactly targeted to this problem of measurement. What are the units that I'm supposed to use to measure the impact that I'm having?
what is the evidence base for the impact that I'm trying to generate, and in my opinion, the sort of the magic behind the Iris catalog is that it draws upon all different industry indicators and frameworks, and so it really ensures that you're using best practice within your key domain and within your key sector to communicate and track the impact that you're having. And finally, measure, track, and use the data. Just two kind of quick examples that I thought were very, very fun and will hopefully get the message across without being too dry. This is a company called One with the Elephant. You can't see it. Now I'm realizing. No, we have to get this back up. Oh my God.
Yeah, we saw it all around the floor.
People that can't see very well.
Send it to us.
Okay. Anyway, there's a very cute illustration of an elephant.
Gone.
Okay. So there's this company, this impact company called Bulb, which is a UK company, and it's helping households get access to renewable energy. And so every I think 6 months, they send out an impact report to their clients with an illustration of an animal that is the equivalent of the carbon dioxide savings that they had. So they translate the weight that was reduced or that was saved into the weight of an actual animal. And so you can really kind of get a sense
of the impact that you're generating, and they quantify it and they show it in all different ways in terms of, you know, the amount that our customers saved with reduced in carbon dioxide is the equivalent of planting 7,000 trees in Brazil, or is the equivalent of getting 1.1 million cars off the road. And so as a company, you can really play around in very interesting and communicative ways about the impact that you're generating. And then of course, you know, it's fun and it catches on, and this will help you as a company get more clients at the end of the day, and that's really what it's all about if you're a company. And then Lien Data, which you can't see, is a tool by Acumen, which is kind of a very, very easy approach for gaining and accessing customer feedback. So I went through a little bit about it's back, and that's not me, but so the Lien Data is about accessing client feedback. And so the idea is that you don't want to go through this like very rigorous approach, very burdensome approach as a small company, especially. Here, the Lien Data framework gives you some key questions that you can ask your users in order to see, okay, how can I hone my business? How can I reach the needs of my beneficiaries more effectively? How can I cater to their needs? How can I perfect my tool, my company? And then also, how can I get data back in terms of who are my users in general? And this is extremely useful. Here you see the elephant finally. Okay, my mission is complete. So yeah, I definitely encourage you to look into those types of tools and consider those practices. And then just kind of some key takeaways. Impact investing is about investing into companies. Companies, organizations, and funds with the intention to generate a measurable social and visual, social and environmental impact alongside a financial return. Impact measurement is about managing. It's a management tool. It's a management decision. It can inevitably make your business more fit for market. It can help you tweak. It can help you pivot. It can help you adjust your market practices. It can convey the savings that you're able to generate to public bodies, whether it's municipalities or federal governments. And it's about also showing the contributions that you're making ultimately to these global challenges that we all face around the globe. And so finally, thousands of companies, as I've demonstrated, and thousands of investors I thought you would actually not have this slide because I wanted to say thousands, and here it's actually hundreds. So anyway, thousands of investors are doing it globally, and we at Social Finance and and all of our partners in the local impact investment scene definitely encourage you to do it too. Does anybody?
Do you have questions for us? Undoubtedly, my next startup is presentations in conferences.
Yeah?
How do you get over this stuff? That's a startup, huh?
It's okay, it happens.
Yeah, please, back there.
My understanding is that you can kind of divide the investors into those that specifically target impact-driven companies, and then investors that would be happy to invest in an impact-driven company so long as the return and the trade-off is sort of within a particular range. Are you able to speak to sort of how measurement maybe differs between those different investors and how it is to work with one versus the other, if there's like a strong tendency towards one?
Sure, I'll answer that. I think, thank you for the question. Did everybody hear? There's a microphone for people. But kind of how do you kind of navigate those differences of approach and differences of kind of focus, I guess, and what type of depth of impact are you looking for? It really does vary across different investors, and I encourage you to ask the impact investors that are here in the room and here at the conference. But essentially, it is a decision that's going to be made by the investor in terms of what is the objective of their investment, what is the universe of companies that they are comfortable looking at and that they would like to look at, and kind of applying the measurement tools to seeing what kind of impact will be surfaced. So if you even look at the latest impact investment survey put out by the GIN last June, and another one will come out, of course, this June, you see an array of different practices by impact investors. Some of them are using the IRIS metrics, but a large majority of them are using their own proprietary tools to make the selection decisions, to analyze the company, and then also, of course, it depends company by company what impact you're going to be reporting on. So this is a very highly dynamic space, and the ecosystem is working to try to unify all of that data together. But for now, it is according to kind of where the investor is coming from and what their idea of the theory of change is going to be, and what outcomes they're ultimately trying to bring about. Yes.
I work on a project where we are working in a community where we foster entrepreneurship and leadership and work on the environment. My question is around how do you measure leadership? Because we work on a leadership program, and we're on our third cohort. And it's obvious the benefits of a leadership program, but how do you measure it?
So, yeah.
It takes me back, to scholarly work. How do you articulate a research question? Okay, so the work is what is the question you wanna research to answer? Like it's not leadership. It's a what we call a nominal definition. It's not the operational definition, which it's kind of a general theme. But then it's like how many students go to high schools or graduate or stay in the community or I don't know, engage with older people in community projects. There's numerous ways to define social intervention, but it just what are the questions you want to answer, and is your project, what is a startup? Does it have to show its profits? Not an NGO, okay? It depends what is the structure that your entrepreneurship is based upon, okay? Because if it's an NGO, it's a non-governmental or non-for-profit initiatives, then I don't know. There's the whole issue of financial a measurement, maybe it's not relevant, but the social is very relevant. But then you just need to structure a research, like any scholar do. So it's kind of going back to basics, I think. But if you have specific things you want to think about, so we can talk about that.
Yes.
Right. When you're talking about CSR,
Yeah.
so I think you both kind of touched on different things. You can talk about the business case because you want to be compliant when there's regulation that holds you to it, or you can talk about the importance of it because the market sees a value, or like customers or something. And I'm wondering about the business case for CSR in places where you might not have one or the other. Like my impression is that in Israel, for example, the public, for the most part, the consuming public doesn't care that much about companies that have a CSR policy. And likewise, there's relatively little regulation that would encourage it. And so I'm curious if there's a business case that stands alone without the need for like customer demand or regulation, that you can say CSR is good because it makes companies more efficient, it makes employees happier, right? And you're going to be a better business if you're engaged in those kinds of practices.
We can start the whole semester here about CSR. I don't mind doing that. I'm doing that next week. Basically, I don't know how to answer without going into too much detail. But first, make the differentiation. CSR is beyond compliance. It helps companies to stay at this level of beyond compliance, but it's not a tool that helps them be compliant with the law. You know that they have legal consultants. Obey the law. No, it's not part of being responsible. Responsibility stands upon voluntarism, doing things beyond compliance. But then you have different case studies or different benefits. Why a corporation should embrace CSR, corporate social responsibility, or sustainability policies. Okay, and you mentioned all of that. But basically, it's how you better engage and better manage your relationships with your stakeholders, with all the social, environmental, public organization you have with your workers, suppliers, whatever. So the business case is huge, but not always there is a business case. But that's the difference between impact. Okay, impact starts with the business case. CSR might end with a business case, but doesn't have to. What we say, doing good is doing well. But if you're doing bad, it doesn't. If you're doing bad thing, it doesn't mean you shouldn't do that. Okay, so. So you need to make these categories, okay? Impact starts with the business case and prove your business case. If there isn't going to be a business case, your investors you're not going to invest. We say that there is what you call a shared value, whatever, to this issue of impact. But CSR, it's kind of a different realm, okay? I hope I didn't confuse you more, but we can continue discussing that a little bit.
Let's distinction. So okay, so then let's talking specifically about CSR. Is there a business case where that stands alone as something that's worth investing in?
Sometimes there is a business case for CSR, and sometimes there isn't a business case for CSR. But there is a moral obligation to implement corporate responsibility. Okay, it doesn't always pay the bill to work according to corporate responsibility, but once you don't do that, you're probably going to pay the bill anyway. Okay, so like take the banks with old people. Okay, closing branches. Okay, they close branches. Why? They're all going digital. But what about my 93-year-old grandmother? She cannot go digital. So they weren't very corporate responsibility kind of corporations, and they got the criticism, and now they're trying to fix it by sending out these nayadot and doing a campaign and like regaining trust, what we call the social license to operate. So there's a rationale in corporate responsibility, but sometimes there is a business case and sometimes it's just the right thing to do. Why? Because that's the right thing to do. Or what we call about the decree of do no harm. Okay? You're going to earn more if you're going to pollute. Let me tell you that. You're going to earn more. But it doesn't mean you can do that. Even if you're going to escape the law.
I think just to add to that, we talked about impact investing, but there's responsible investing, which is, I think, like $22 trillion are invested under this approach. And so investors are increasingly looking for, corporate responsibility performance, and there are really serious metrics about how you can assess actions about corporate social responsibility. And then I'll say the second part afterwards, because I think we need to wrap up. But definitely, if you have other questions, please approach us and please connect with each other.
And they all waited for the pins. It wasn't us. We weren't. Like they waited for the tokens.
Oh, right. Of course.
Thank you all for coming, and enjoy the rest of the conference.